Good evening, everyone, and welcome to another session of the Brian Crombie Radio Hour on Saga 960. I saw some really interesting columns in the Globe and Mail recently about a contrarian and his attitude toward what's going on in the marketplace, and particularly uranium in Kazakhstan, which was kind of interesting. And so I thought I'd check in with Phillip MacKellar, who is with a firm by the name of Contra, the Herd Investment Newsletter, and ask him what's going on. So Phillip MacKellar, an analyst and portfolio manager at Contra, the Herd Investment Newsletter. Welcome to our show. How are you?
Hi there. I'm very good. Thank you for having me. Excellent.
So Contra, the Herd is a Toronto-based company and has been in business since 1995. You've been with the company since 2011 and investing since 2004. Tell me a little bit about your background and how did you find your way to becoming an analyst and portfolio manager at Contra, the Herd Investment?
Yeah, so I started out at Contra the Herd in 2011, and prior to that, I had graduated a few years before. And between when I started working at Contra the Herd and when I graduated, I worked as a financial advisor. I found financial advice quite interesting at the time, and it was something that I was always passionate about. When I got into the industry of actually being a financial advisor for individual people, I found that it was not as interesting as I had hoped it would be, and that it just wasn't quite for me. The job was more or less a sales job of selling insurance or selling mutual funds or selling ETFs or whatever it happened to be. And it was less about the analysis and nuts and bolts of getting to know companies and understanding how companies work and what drives a valuation higher or lower. And that's when I reached out to Benj, and that's how I found him and eventually wound up with Contra the Herd.
So your newsletter's primary focus is on being contrarian and what you describe as deep value investment opportunities in Canada and the United States. Tell me what's contrarian and what's deep value?
That's a very good question, because a lot of people, they say they are contrarian. They say they are deep value investors and they're going against the grain. But when I say contrarian, I very sincerely mean it. Many of the companies that we invest in, or at least when they end up on our watch list, they are so beaten up and so unloved and sometimes outright hated for reasons that can range from there's just been a financial crisis and all the banks are really bad, or there's a massive amount of litigation going on in the likes of Camco, which we can talk about later. And as a result, many of the companies, when we start to get really interested and start to do our due diligence, they're trading at or near their 52-week lows. They're often miles lower than where they were 3 years ago or 5 years ago, or sometimes even 10 years ago. So the stock charts look ugly. The valuations versus where they used to trade, they could have been a stock market darling at some point, but their valuations compared to where they used to trade, they're often way, way down. And they're just ugly. And there's often something wrong with them, which we try and then understand and see if the company can work its way through whatever trouble it's facing. So that's what I mean by deep value investing and contrarian investing. Obviously, we then go and hold the companies for quite a long period of time afterwards and hope that they can get through their current turmoil and then turn around and return to be a stock market darling or go on a big, huge rally or something of that nature. But yeah, that's what I mean by contrarian investing. When we get interested, we're looking at things that are very beaten up.
So to look at things that are really beaten up, you got to believe that they're overly beaten up. And some people believe that when things are at a high, they're overvalued because of momentum or because of overenthusiasm. And when companies are beaten up and at a low, they're undervalued because their sort of perceptions are even worse than the reality. Do you agree with that? Do you believe that?
Well, it can certainly be the case. Not in every case. There are sometimes very good reasons why a high-flying tech name, for example, is a high-flying tech name, and other reasons why a company hitting its 52-week lows will continue to make new 52-week lows. That's where analysis really becomes very important and quite critical. And that's, if a company is having covenant issues with its debt, if its debt is piling up, if the bankers want to reduce its line of credit, if the bankers are getting nervous, those are reasons why a company may continue to make new 52-week lows. A company might also need to issue a ton of shares and dilute shareholders. And there are lots of reasons why companies can make new lows upon lows upon lows. So that's where our analysis hopefully can come in and suss out what should do well and should recover and what may not recover.
So how do you find these opportunities? Just look at what's at or near its 52-week low?
That's one way. So the primary thing we do, we have a number of ways actually that we find opportunities. The main way though is a stock screener, kind of like what you were alluding to there, where we will screen the market and look for companies that are trading at or near their 52-week lows. We'll also look at companies that, usually the companies we look at have been listed for 10 years. So that knocks out a lot of potential companies that could make it onto our watch list. And then we'll just look at the valuation metrics. We'll try to look at debt metrics and things like the current ratio and the working capital and seeing how all of that comes together. And from there, we will generate our watch list and we'll try to dig into the details. So that's the primary way that we find opportunities. And I don't think it's too different from how other investors find opportunities. It's just a different set of criteria. And then in addition to having screens like that, we will read a lot of analyst reports. And sometimes companies pop up that we never heard of just by reading an analyst report. And that's great because you can then go and actually reach out to the analyst and ask further questions. And oftentimes, if they're an industry-specific analyst, they're a really good person to talk to. And that's quite useful. We sometimes watch other programs, we talk to other investors, or we read in the news what other investors are up to. And occasionally that will generate leads and companies that can come onto our watch list. And then the third thing is our subscriber base. Generally speaking, they're fairly knowledgeable investors. They use our service in a variety of ways, but some of them supplement for research they're already doing on their own. And as a result, occasionally we'll get subscribers emailing us in with a few ideas, and we'll always look at them and get back to them as to what we think of them. And as a result of that, some of those companies end up on our watch list too. And that's quite a good benefit, I guess. And people also reach out online and on the internet and say, hey, I have this stock, what do you think of it? So those are the ways we find our names. I would say it's 75% just a very basic screen. That's where our ideas come from. And then 25% of our ideas come from these other sources.
Now, I found you because of a column that you wrote in the Globe and Mail. I think you also published in something called Seeking Alpha, the Canadian Money Saver. And you do blogs about personal financial topics at your own website, mymoneymoves.ca. Is that correct?
Yeah, that's right. I do. And My Money Moves is a very different service from Contra the Herd. So Contra the Herd is like a premium subscription-based service for fairly knowledgeable do-it-yourself investors who have their personal finances in order and some money behind them, and they can take advantage of investing over time. That's who it's really geared towards and who it works for. By contrast, My Money Moves is on the opposite end of the spectrum. It's for novice investors. It's for those who are new to personal finance. It's entirely free. It's not a premium subscription service. And its focus is really on financial literacy and making a strong financial foundation. And I started this website because a lot of people, especially younger people, they will start talking to me about some hot stock or ETF or a cryptocurrency or something like that. And they are so fired up and so passionate, but they don't have their personal finances in order. So this website, My Money Moves, is an attempt to give people like that resources so they can get their personal finances in order first before moving on to investing. Because if you put your personal finances first, you can make a lot of mistakes and your portfolio and your wealth will be okay. But if you get into the stock market first and you have tons of debt or student loans or credit card debts, that could be a recipe for disaster. You could get very hurt in that process. So My Money Moves is an attempt to help people put their finances first, and then from there, invest from a position of strength and hopefully build their wealth over many, many years.
I'll have to check it out. Sounds good. We're chatting today with Phillip MacKellar, who is an analyst and portfolio manager at something called Contra, the Herd Investment Newsletter. We're going to take a break for some messages and come back more with Phillip and talk, I think in our first session, a little bit about the markets and inflation and interest rates and what he thinks is going to be happening there. And then we're going to focus in on our third session on a fascinating investment opportunity that he indicated in Kazakhstan in uranium. which I found really interesting. We're going to take a break. Stay with us, everybody. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. We're chatting tonight with Phillip MacKellar. He is an analyst and portfolio manager at Contra, the Herd Investment Newsletter. It's a Toronto-based company. It's been in business since 95. Phillip has been with the company since 2011. And the newsletter's primary focus is on contrarian and deep value investment opportunities. Phillip also writes in the Globe and Mail, Seeking Alpha, the Canadian Money Saver, and he blogs in his personal finance topics at his own website, mymoneymoves.ca. We're talking tonight primarily about contrarian investments in the market and what's going on. Phillip, let me just, off the top, get your opinion about the market. So number one, the stock market is, at all-time highs, is it not? Interest rates are at all-time lows. We've got unemployment at lows, surprisingly lows, given what's been happening in public health and with COVID-19, et cetera. Some people are worried. They're saying that we're going to have interest rate hikes as the Bank of Canada and the central bank in the United States and frankly, banks around the world increase interest rates to dampen inflation. This is going to have a negative impact on valuations, on cap rates, on PE multiples. And the market could go down, and that it actually could even trigger a recession. Tell me, what's your perception of what's going on in the markets?
Yeah, well, I think your summary there is fairly good. And the outlook today is difficult to hazard a guess on. And it's never easy, frankly, because macroeconomics has so many variables that go into it. And if you get any one of them wrong or you miss a variable, your entire thesis may be off. So I would say you've hit on many important factors in the markets today. To me, the big factors to consider are where are interest rates going and where is inflation going? And there are three kind of outlets that I can think of. One is you get a wage inflationary cycle, and the wage inflationary cycle, what that does is it could be not hyperinflationary, but very, very bad. Or you could get a rapid rate of interest rate increases to try and catch up and catch inflation and bring this back under control. And this chart here, it shows actually over time, the interest rates and inflation rates, they try to more or less match. There are periods where interest rates exceed inflation and vice versa. So we might be heading for a period where the two kind of come back to where they have tried to be historically. And then on the other side, you could have deflation. I mean, it's not out of the question that the Evergrand saga in China spills out and ripples out into other financial institutions and real estate development companies in China. And if that really got going and the Chinese authorities couldn't keep a lid on it, which I assume they would try, but let's just assume they couldn't keep a lid on it, that could be deflationary because the Chinese real estate market, it's got a lot of debt associated with it. And the Chinese real estate market consumes so much of the world's raw materials, from aluminum and steel to concrete and wood. And, if that asset class did blow up, that could be deflationary. And frankly, no one knows which of these three scenarios we get. We don't know if we get very high wage inflation. We don't know if we get interest rates catching up and kind of keeping inflation where it is or bringing it down. And we don't know if Evergrand will implode. And those are just the variables, some of the variables to think about. And unfortunately, I think that makes it quite tough for investors. I personally think that inflation is more likely, and that could be problematic when you look at your options. So if you're an investor looking at options and you're thinking about what do I do if inflation is high, so you talked about stock market valuations compressing and valuations coming down. And you could argue some of that's happening right now in the tech space. And that's problematic because valuations are still pretty high. So there could be a lot more valuation compression happening in equities. On the other hand, though, the alternatives to equities don't look that great. I mean, inflation destroys the value of cash and bonds pretty effectively. So that looks problematic, especially if you're at or near retirement and you're a pensioner. And then commodities are generally a good thing to invest in during inflationary periods, but they're very volatile. So a lot of investors, they think they can stomach the volatility, but when they actually get into the commodity, they find they can't. So that's problematic. And then real estate, at least in this country, if you buy real estate today, you're probably going to take out a huge mortgage. And many people who have recently bought real estate are taking out huge mortgages, and they could be crushed if interest rates really, really rise, and they have to either reset their loan in 3 years or they're on a variable rate. So real estate, I'm not sure it's a good place to be either. And then some people look at cryptocurrencies as the place to be, but the volatility there is way worse than in commodities. And it's such a new asset class that there's no historical data with which to actually make an educated guess. It could be a great inflation hedge, but it could be disastrous. And there's just no data there to back up either way what will actually happen. So I don't want to sound too doom and gloom, but that's the outlook today.
You pretty sound doom and gloomish. So real estate, you don't want to invest in because you think that interest rates are going to go up, and people that have got in real estate, my understanding is that variable rate mortgages are almost an all-time high, and so even though we've got, sorry,
that's my understanding too.
And so even though we've got incredibly low long-term rates, almost historically long-term rates, low long-term rates, people are still choosing to take the advantage of going to the short end of the yield curve and going with floating rate. And so they're at risk for some sizable increases. And, if the rumor is true that there's going to be 4 rate hikes this year of 100 to 200 basis points total, that's a significant amount. That's almost like, a doubling potentially of some people's interest rates, or at least a 1/3 increase in their interest payments if they're in a variable rate mortgage, isn't it? And then mortgage levels are high, real estate asset levels are high. Some people have done analyses that suggest that house prices to rents and house prices to income are at an all-time high and at comparable levels to what the U.S. was in 2007, prior to the real estate crash in the United States in 2008, 2009. So you don't like real estate. You say that the stock market is high and potentially could compress. You don't like bonds and cash because of what would happen to inflation. You don't like cryptocurrency because it's volatile. So where do you put your money?
Well, I'm biased towards equities because I still think they're the best game in town. They're not a flashy game, and I don't think they'll be without their lumps, but I think it's the best place to be. I also do hold some cash. I've been trying to work down my cash position over the past year, but I hold cash because I think if there is valuation compression and say the NASDAQ continues this current sell-off or the S&P continues to sell off, that will give me the opportunity to go and buy some new positions and add to existing positions in the process. So the main thing I'm doing is I am still investing in equities, and I'm still holding a bit of cash to take advantage of what I think could be valuation compression if inflation does stay where it is and interest rates catch up. And I would say that even if interest rates and inflation don't pan out the way that a lot of market commentators are thinking, the valuations are still very high. So there could be just a undoing of the bull market for reasons unrelated to inflation, which just see the valuations come back down to more normal ranges or historically normal ranges.
So some people have been saying that the typical business cycle is, 7 years. And other than the pandemic, which obviously was a fairly sizable impact on the economy, we haven't had a bear market in a while, and we're due one. What do you think of that?
Yeah, it could be. If you were investing through February and March 2020, that was certainly a bear market, no doubt about it. It was fast and furious, and the stock market has recovered wonderfully since then. But in February and March of 2020, a lot of people thought the world was going to hell in a handbasket, and the rate at which the stock market sold off was astonishing in February and March 2020. I think it was down by a third in just over 2 months, which is super fast. And I know it popped back up, but boy, that was a very steep bear market. And for those who had the gumption to go and just start chipping away and buying stocks during that period, that was a pretty good thing to do, and that was a smart call. So
Donald Trump was right. We had a V-shape or a hockey stick recovery. Is that correct?
Yeah, oh, for sure we did. When the central banks of the world, when the governments of the world, they really put a backstop in it by starting very large amounts of quantitative easing, by taking interest rates down, as we mentioned, to zero, and then these large stimulus plans, which were put in place to see businesses and people through the worst of it. Those really backstopped the downturn. They created a whole bunch of other problems, as we know about now. I mean, the supply chains of the world are messed up. The amount of money going around, circulating around the economy now is probably driving a lot of this inflation. And then by essentially maintaining people's purchasing power by giving them these government funds, but not having them work, meant that they were still consuming, but they were no longer contributing to the production of goods and services which others needed. So that created, I think, what are pretty big distortions and are part of the reason why inflation is where it is.
So tell me a little bit about where you think inflation is going to go, because some people think that inflation is transitory. It's caused by these supply chain disruptions, and it's going to come back down again. Other people think no, because of these historically low interest rates. They've driven a huge amount of growth. I think it was some of the highest GDP growth and beating expectations in Q4 of last year. And expecting, as I said, this V-shape or hockey stick type recovery. And this is the highest inflation we've had in 10 years. And we haven't had, sort of inflation, above 5% really in almost 50 years. And could this lead to stagflation?
Well, it could lead to stagflation if there's an economic downturn now and the economy contracts, but the inflation rate remains where it is or even half of where it is. That I think would qualify as stagflation, and that wouldn't be very good. I don't know if it will happen. The risk is, of course, that it runs away on you, and that's what tends to happen during inflationary periods. Is it really rips higher, and you're seeing that now. I mean, the inflation rate has really ripped higher here. So if it continues at that pace, that's not a good thing, and that's a big headache for policymakers. So I don't know where it's going, but the risk is that it runs away on you, and then you really have to clamp down.
Let's talk about some of the impacts, and let's try to peel it back. So supply chain disruptions. People have been talking about that, but they don't seem to have been solved. And what's going on in Russia, Ukraine could impact that again even more. I heard a report saying that if anything happens there, the economic sanctions that the United States is threatening could devastate the economy in Europe and result in skyrocketing energy prices, gas prices. A Republican senator said, it could have the biggest impact on gas prices that we've had since the OPEC crisis back in the 1970s. If the sanctions cut off natural gas and other things. He actually said, it was interesting, he described Russia as a gas station masquerading as a company, as a country, which I found kind of extreme. So talk a little bit, if you could, about supply and these connections that seem to have been severed during the last couple of years. And then the other thing is wage price inflation. And, there's so many people that are complaining that they can't get workers because of government subsidies, government payouts that have paid people to stay at home because they're worried about COVID. McKinsey and other people have written articles about the Great Resignation, saying a whole bunch of millennials spent time during COVID and decided they didn't want to work for corporations. And so therefore they're quitting en masse and starting entrepreneurial opportunities and going to Florida or Whistler and trying to work remotely. And therefore, if you try to find employees, you can't find employees. So address two things, if you could: supply chain disruption and wage price inflation.
Yeah, so on the supply chain disruption, it's a huge issue, and I think it goes far beyond energy. It goes into the container ships that circulate the world. It goes into the transportation networks. And I just think there's so many factors which go into it. People calling in sick is a big one. People getting the wage subsidies and deciding not to work or look after a sick family member or something like that, that contributes, and it trickles. Even though it's just a few people here and there, if it's done on a countrywide scale, it really trickles through, and it makes for quite dislocated supply chains. And I don't know when we're going to get through that. My wife's business, they are a exporter in the US, and they export label paper to markets throughout the world. And it's a very small niche market. It's quite a small company in the grand scheme of things. But her days for the past 6 months have been nothing but trying to get container ships and trying to get their product to the ports to load on the ships to go to any market where their customers are. And it's been an absolute nightmare. There's no other word for it. It's just an absolute nightmare. And unfortunately, we talk about it regularly. And from her perspective and from what her company is seeing, it's not getting any better. It remains very challenging, and the port delays and the ability to even grab a container are very, very low. So I don't know how this resolves or when it resolves. My guess is it will take quite a bit of time, and maybe the Chinese Lunar New Year helps a bit, and that helps catch us up. Paying people more when they're shipping our goods or when they're working at the ports, that would help too. I would assume, and send some people to come back to the workforce and help us out. So I don't know when it ends, but it's certainly a big issue. And I can say in my household, I see the issue every night at dinner when we talk about what's going on and what the day's been like. And then as you talked about the wage pressure, I think that's very much related. It seems like the paradigm has flipped. In the past 30 years, wages have generally slowly chugged higher, but they haven't leapt up. And that's really changed recently. So I'm still trying to wrap my head around that and what it means. I think it means that inflation should be higher, generally speaking. And when you think about supply chain inflation, it's not as sticky, because once the supply chain is resolved, things should mellow out. But wage inflation and, say, rental price inflation, those can be much stickier. So I think that's a longer term issue, is what I would say there. And my guess is that blue collar workers now, they feel incentivized to unionize. They feel incentivized to use their union powers. And even if you're not in a union and you're not making, say, minimum wage, your wages are probably going up. And that seems to be happening across the board, not by small increments either, but by quite large increments.
Yeah, no, it seems that there is a significant amount of wage inflation. We're chatting tonight with Phillip MacKellar. He's an analyst and portfolio manager at Contra, the Herd Investment Newsletter. We're going to take a break for some messages and come back more with Phillip. He had a fascinating column in the Globe and Mail recently that I really found interesting. He was suggesting that a company that is a producer of uranium in Kazakhstan is worth investing in. I hardly know where Kazakhstan is. I had to actually check it on the map. And I didn't realize that Kazakhstan is a major producer of uranium. And you know, interesting enough, right after he published the article, Kazakhstan came in the news because Putin sent some troops into Kazakhstan. And so, you know, it's got some political, some economic, some climate change issues all surrounding this country and this investment. We're going to take a break and come back more and talk a little bit about uranium, Kazakhstan, and maybe come back to Evergrand, this Chinese real estate development company that Phillip mentioned off the top as well. Stay with us. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. We're chatting tonight about the investment outlook for the year, the outlook for interest rates, the outlook for inflation with Phillip MacKellar. He's an analyst and portfolio manager at an entity called Contra, the Herd Investment Newsletter. Contra, the Herd is a Toronto-based company. It's been in business since 1995. Phillip has been with the company since 2011. The primary focus of the newsletter is a focus on contrarian and deep value investment opportunities. Phillip also writes for the Globe and Mail, Seeking Alpha, the Canadian Money Saver, and he also blogs about personal finance topics at his own website, mymoneymoves.ca. Phillip, I read this column that you wrote in the Globe and Mail about, is it called Cameco?
Yes.
It's a uranium company in Kazakhstan. And you were suggesting that there was an opportunity to invest in it. And, you know, I was interested because I didn't realize that Kazakhstan was a big producer of uranium. I didn't know about Cameco. And, you know, lots of stuff has been going on in Kazakhstan that we just heard about recently in regards to Russian troops being called in by the president of Kazakhstan. So tell us a little bit about why the heck would you want to invest in a company in Kazakhstan?
Yeah, so Cameco is its major assets are actually in Saskatchewan. It has a joint venture in Kazakhstan, and that joint venture is through Kazakh, which is a big semi-state-owned utility or mining company, uranium mining company in Kazakhstan. So our investment through Kazakhstan is secondary, I would say. The main assets that Cameco has are safely and soundly sitting right there in Saskatchewan in a very safe jurisdiction where the odds of something like what happened in Kazakhstan are quite low. And we invested in Cameco in 2019. It's a very big company, and we've sold 40% or just over 40% of our position. And we did that late last year at about $34 or just over $34. So that was quite a good run, but obviously given we have more than half our stake left, we think there's more to go. And when we bought it, we thought it was a fairly straightforward thesis. Cameco is really a world leader in uranium mining. They have some of the world's biggest deposits outside of Kazakhstan. And as you mentioned, Kazakhstan is a huge player in the uranium space. Over 40% of our supply globally comes from that country. So it makes
40% of global supply of uranium comes from Kazakhstan.
Yeah, it's a big deal, and it's a lot coming out of that country. And I
never had heard that before. Fascinating.
Yeah, so the Nuclear Energy Association has a great report that they publish each year, which breaks down what countries produce how much, and Kazakhstan is by far and away the leader. And then
is it because they've got more reserves, or they're just mining more of it?
Actually, the biggest reserves in the world are in Australia, and then secondarily Canada, and which is almost exclusively tied up in Cameco at this point. And then it's Kazakhstan, and I think Niger are 3 and 4. So the deposits in Kazakhstan are very, very cheap, and they're easy to extract. And that's why at the moment, and for as long as I can remember, they've been the #1 player in the world.
Tell us a little bit about how political unrest in Kazakhstan and Russia impact your investment analysis.
Well, it was actually a big part of the analysis when we first bought our initial stake in 2019. When we looked at it, we thought, because of there's so much concentration in a geopolitically unstable region, it could benefit from having assets outside of that. So having assets in Saskatchewan is a very compelling reason to invest in an oligopolistic industry like uranium. So that was part of our thesis. At the top of the show, I also said how we like investing in turnarounds, and we like investing in ugly companies that have something wrong with them. And in 2019, there was a lot going wrong with Cameco. If you ever read through, they've had a massive CRA dispute going on for decades relating to the use of a subsidiary overseas in the early 2000s. And that lawsuit was worth $2 billion plus. And now it's more or less resolved. But back then, nobody wanted to touch Cameco because that's a lot of money. And it didn't know, or the market didn't know how the CRA case would unfold. But we actually invested at that time because we thought they would win based on the fact that a similar case in the US had gone Cameco's way. We liked how Cameco is idling some of its production to wait out for higher prices. And behind the scenes, insiders were buying. And that's always a very interesting sign when headlines are bad, but when the people in the know, the directors and the management, are purchasing shares in the company, that's a pretty clear indication to us that something's going on that is maybe more positive than the market perceives.
What do you think is going to happen in Kazakhstan?
Well, no one really knows. The desire for authoritarian governments to stay in power is so incredibly high that my guess is they put down any revolt or future revolt fairly firmly. And, you know, people very regularly talk about how China's days as a dictatorship are going to end soon, or somebody's going to overthrow Putin in Russia or something like that, or North Korea for that matter. And maybe one day, but inertia is really high, and I think it's incredibly hard to actually get rid of these dictators. So my guess is that these dictatorships remain in place, more or less. That's my assumption anyway when I'm investing, but that the unrest that can happen in those countries is such that it can put the supply of whatever that country does in question. And in the case of Kazakhstan, it's putting the uranium supply in question.
Cameco's stock, as you said, is up, but still below where it has been in the past, but on very low volume. Tell us a little bit about how you think about their stock.
Well, these days, I think there's room to run. They've come back a bit with this latest downturn in the stock market, but I wanted to hold over half of my existing position because the main thing is they've won the CRA case now. So that's off their back. And the CRA could come back and try to drag this out further. But honestly, they've lost in court so many times at this point that I think any fight on their part would be counterproductive. And then in the background, you talked a bit about climate change. To me, it seems that if we're going to address climate change and decarbonize, it's probably a good idea to have nuclear as part of that equation. I know it's ugly and people don't like it, but it's just very hard to imagine making substantial reductions in greenhouse gases without uranium as part of the mix. And hand in hand with that, after the Fukushima power plant explosion and the earthquake in tsunami in Japan, the uranium market entered a bear market for 10 years, and that seems to be abating now. The outlook for nuclear growth over the next 10 years looks pretty good, and it looks like the market is very undersupplied. So it suggests to me that Cameco could go higher from here. And when you add on protests like what we saw in Kazakhstan, where most of the world's supply is coming from, that's just an extra kicker on top. So that's my outlook on Cameco now. I'm fairly happy holding 50% or more of the existing position. It's nice to have taken a profit, of course, on some of it, but I think it could go higher. But I should say, before we maybe move on to other topics, the risk of a nuclear meltdown is always there. And anyone in this industry has to have that in mind. And anyone who's thinking of investing in this industry has to keep that in mind, because while countries like France or the US or UK have fairly good safety cultures and fairly good safety standards within their nuclear industry, there are a lot of nuclear reactors in places where the safety culture isn't that great. I mean, Russia does not have a very good safety culture in their mines, for example, and that permeates through to other industries, and same with China. So I think the odds of a nuclear meltdown, they're low everywhere, but they're higher in certain places than they are in other places. And that's a risk that investors have to be comfortable with. You could wake up one morning and there could be an awful meltdown, and the social environmental issues could be terrible in that region. But for you as an investor, that could hurt your economic rationale for owning a uranium miner like Cameco.
I've been watching a miniseries on Netflix about Chernobyl, and it's kind of harrowing. I'm not sure if you've seen that miniseries. But I also had a emergency room physician in Toronto at St. Joseph Hospital that has, from a volunteer standpoint, become head of a nuclear association. And he went to COP26 in Glasgow with the one stated objective of persuading the world that climate change is this biggest issue we're facing, and there's no way we can solve it without dramatic investment in nuclear. He says wind and solar is just never going to do it. And one of his arguments is interesting. He said, we used to have smog days in Toronto, and we've had, from a jurisdictional standpoint, the largest reduction in smog, the largest reduction in climate change impact in Ontario. And it's primarily because, if not completely because, closing down coal-fired plants and replacing it with nuclear. I found that kind of interesting.
Yeah, and I think he's onto something. I would agree with him that climate change is a pretty big issue. I would definitely say the trend isn't our friend. I mean, each year you see the CO2 gauges at the Hawaiian station going up, and you see the weather getting worse. I mean, here in BC, we've had a terrible summer and now a terrible winter, and we have our roads washed out and our forests burned down, and it sucks. You can't go out and have campfires like you used to in the summer. And in the winter is just awful. You have gas rationing now. So yeah, the trend isn't our friend with climate change. And I think countries are starting to recognize this. In Europe right now, it's actually a big debate. On the one hand, you have Germany, which is decommissioning its nuclear power stations and doesn't want to include nuclear in a green energy standard, which the European Union should be rolling out sometime early in Q2. But on the other hand, you have France, which has a lot of nuclear, as you probably know, saying, well, nuclear is an important energy contribution to a clean economy, and it should be included as a green fuel standard under this European framework. So we'll see how that shakes out. I don't know which country and which perspective wins out there, but I certainly hope in this case that nuclear does have a bigger say in the energy mix going forward. Because the need to displace coal is growing.
We're chatting tonight with Phillip MacKellar. He is an analyst and portfolio manager at Contra, the Herd investment newsletter. We're going to take a break for some final messages and then come back. And I'm going to ask him about Evergrand, this Chinese real estate development company that Phillip mentioned on the top, and whether that could create a financial calamity, because some people think it might. Stay with us, everybody. Welcome back to the Brian Crombie Radio Hour on Saga 960. We're chatting tonight with Phillip MacKellar. He's an analyst and portfolio manager at Contra, the Herd investment newsletter. His newsletter focus is on Contrarian and deep value investment opportunities in the United States and Canada. We've talked about uranium and Kazakhstan and a company by the name of Cameco that has investments in uranium, both in Saskatchewan as well as a joint venture in Kazakhstan, which is kind of interesting. We've talked about inflation. We've talked about interest rates. And Phillip, on the top of the show, you mentioned that you were a little bit concerned about Evergrand. I've had some people on my show talk about Evergrand, this real estate development company in China that is teetering on financial collapse, as something that could be akin to the subprime market in the United States and could trigger a worldwide financial calamity. Are you worried about that at all?
Well, it's something, yeah, I would be worried about that. I have to, as an investor, I try to be worried about everything with a degree of rationality, is what I would say. So yes, I worry about inflation. I worry about wage price increases. And I also have to at least try and think about what the world would look like if something like Evergrande were to implode. I think now, I could be wrong, but I think now they are officially in default. And it looks like a handful of similar companies, not as big, but similar companies will be joining them in the kind of default bucket. So the question is, does this spill over or does it end here? And we don't know the answer to that. China is a very opaque society, and information out of China is hard to get accurately, and then it's hard to trust once information does come out. So it could end up like the financial crisis. It might. It could also end up like the Asian crisis in 1997, 8, 9, and the issues there. And eventually things will work out and they'll be fine. But in the ensuing period, 2008, 9 wasn't good, and the financial crisis in Asia in the late 90s wasn't good. But I think the Chinese will try very hard to keep a lid on this and try not to let it spill over and bleed into the real estate market, because it's such a big part of their economy. It very well could, but they will try very hard to put in countervailing measures and try to keep a lid on this.
Phillip, this has been a fascinating conversation. You've told us about concerns you've got, belief that interest rates are going to go up to bring inflation down, that inflation has gone up, that you think the inflation that's gone up has been caused not just by energy prices, but because of supply chain disruptions and because of wage price inflation, and that you shared with us a graph that showed that interest rates and inflation tend to track each other, but right today they're not. Inflation is up and interest rates have not come up yet. You've talked about concerns you have in a lot of different asset classes, and yet you've said that you're still investing in equities, and that's the best place to be. Let me ask you a final question, if I could. Given all of your concerns, given what's going on in the global economy, if you were the Minister of Finance, or if you were the Governor of the Bank of Canada, what would you be doing today?
I think I'd prefer the governorship over being the Minister of Finance, though I'd probably quit either of those jobs, to be honest. I think if I were the Bank of Canada, I would be working on higher interest rates now as opposed to later, just because the risk of increasing a lot all at once is worse than the risk of making incremental changes over time. I mean, if I tell you your mortgage is going up by 0.5% tomorrow, you'll be unhappy with me, but you'll be okay. If I tell you it's going up by 2% tomorrow, you'll be furious and you won't be okay. So I would try and avoid that kind of outcome, and I would be incrementally trying to hike interest rates.
But, people have been talking about maybe 100 basis point or 200 basis point over 4 increases. But, based on the charts that you've presented, it would almost have to be like 400 or 500 basis point increases, wouldn't it? That's a huge increase.
That is the risk. I'm by no means saying that could happen, but you read books all about tail risks all the time, and Nassim Taleb writes a lot about black swan events and tail risks, and that would be the risk. Is when I say incremental changes would be better than huge changes all at once. I think that's the risk, and I hope it doesn't.
So if you did a couple of changes, like 25 basis points 2 or 3 times, and you get up to 1 or 200, like 1% or 2% interest rates, and inflation still stays above 5, what do you do then? Do you have to do a big, huge change then?
I think so. And I think that's what makes me uncomfortable today, is I think that's now the position they're in. They're between a rock and a hard place. And yeah, I mean, honestly, at this point, for putting a 0.25% increase into an inflation environment of plus 5% kind of reminds me of like throwing a stone into a wave. It might not do that much. So yeah, that's the risk. And I wouldn't want to be at the Bank of Canada or the Minister of Finance. I'd much prefer to quit those jobs if I had them, because it's a thankless job and it's a hard job.
So if you were Minister of Finance or Governor of the Bank of Canada, you would just quit the job.
I think so. I mean, it's a thankless job, and I'd much rather do what I'm doing.
Well, I happen to believe that interest rates are going to go up. I think they're going to have to go up a lot, because I think that this inflation that we've got is a problem that we really haven't had in 30 to 40 years, other than a little bit around the time of the global financial crisis, and I think it's going to really impact the real estate market. And I think that's and if it impacts the real estate market, then it impacts everybody. It sort of impacts Main Street. Unlike if it just impacts the stock market, it doesn't necessarily impact everyone, or the impact is longer term because it impacts sort of RSPs. It impacts people like you a lot, obviously, in the stock market, but not everyone's invested day in and day out in the stock market. And if they are, it's through RSPs or other things. But real estate, if it impacts real estate and asset values come down, that impacts sort of everyone. And that's my concern.
Yeah. A lot of people are homeowners in this country, and a lot of people have a lot of debt.
Well, this has been a fascinating conversation. Thank you so much for joining us. Phillip MacKellar, analyst and portfolio manager at Contra the Herd investment newsletter. If people want to check out Contra the Herd, what's the best way to do that? Wait till you publish in the Globe and Mail, or is there a website they can go to?
Yeah, you can go to contratheherd.com. You can also find us on Twitter at Contra the Herd. And those are the best ways you can reach us. And like you said, we publish in the Globe and Mail. We also publish on Seeking Alpha and in the Canadian Money Saver. But the best way to reach us is at contratheherd.com.
Phillip MacKellar, thanks so much for joining us. That's our show for tonight on the Brian Crombie Radio Hour. To remind you, I'm on every Monday through Friday at 6 o'clock on 960 AM. You can stream me online at www.saga960am.ca. You get all my podcast and video casts after the fact on briancrombie.com. The videos are on Facebook, Instagram, LinkedIn, and YouTube. And the podcasts are on Audible, Apple, and Speakeasy Podcasts. Phillip, thanks so much for joining us. Good night, everybody.